Welcome to Part 2 of Chapter 18, Mergers and Acquisitions, Divestitures, Leverage Buyouts. Continuing from Part 1, we're talking about the earnings if a merged company remained at pre-merger levels. So, if the stock of the merged company sells at an assumed multiple of 21 times earnings, the table below can be expected. So, although Grand Company's earnings per share declined from $4 to $3.93, and the market price of the shares will increase from $80 to $82.53 as a result of the merger. So we see down here the combined company has earnings of $600,000. The number of shares outstanding, once you add in the existing outstanding shares plus the new shares issued to acquire a small company, we calculated the earnings per share to be $3.93. Assuming a PE multiple at 21, that would put the new shares at $82.53. Okay, so moving on to investment bankers. So these are financial intermediaries who, in addition to the role of selling new securities issues, IPOs or bonds, they can be hired to help in acquiring companies to merge with. To find suitable target companies and assist in the negotiations, an investment bank is a valuable resource in sort of matchmaking between two companies. So they're compensated by a flat fee, possibly a commission tied to the transaction price, or a combination of fees and commissions. So the investment bank can facilitate the proper paperwork, the proper accounting, the post and pre-merger considerations and work that needs to be done. So the investment bank is sort of a one-stop shop to help companies navigate the tricky road of merging with other companies. So to initiate the negotiations, the acquiring company must first make an offer either in cash or based on a stock swap at a specific ratio of exchange to the target company. The target company will then review the offer and decide upon its alternative, either accept or reject the terms presented. Normally, it's necessary to resolve certain non-financial issues that may be present with the existing management. The product line policies, financial policies, and the independence of the target firm. So those need to be thought about and worked out before the merger can be accepted. So other key factors, of course, are going to be the per price per share offer, whether it's cash or ratio exchange, and it has to be reviewed to see if it's a offer worthy of the value of the target company. So it can be a tricky negotiation depending on how well the two companies know each other, how generous the purchase offer is. So when negotiations for an acquisition break down, the tender offer may be used to negotiate hostile mergers directly with the firm's shareholders. So if the firm's management doesn't want to participate in the merger and they're against the merger and they reject the merger, it's possible for the company to go directly to shareholders since they're the true owners of the company and give a tender offer, which is a formal offer to purchase a given number of shares of stock at a specific price. And this offer is made to all stockholders, and of course it's a premium above the current market price. So maybe the market price of a stock is at $20 and they might offer $28 in the takeover. So if you're a shareholder, that's pretty tempting. Occasionally the acquirer will make a two-tier offer, a tender offer, which is the terms offered which are more attractive than those who tender shares early. So there could be, so they basically are trying to encourage people to surrender their shares earlier and get a better payout. Hopefully creating a demand, an upfront demand, which give them a high enough percentage of ownership in the company to take them over. So how do you prevent being hostilely taken over as a company? Well, there are certain takeover defenses and strategies to prevent a hostile takeover. One such strategy is called the white knight. So as a takeover defense, the target company finds an acquirer more to its liking than the initial hostile acquirer and prompts the two to compete and take over the firm. So a white knight would be another possible company to merge with that would be more agreeable to the management, and they sort of pit the white knight against the hostile takeover company. And this strategy usually winds up, if the company is acquired, being acquired at a higher price. There's also a takeover defense called the poison pill. This is a takeover defense in which a firm issues securities that give their holders certain rights and become effective whenever a takeover is attempted. So these rights make the target company less desirable to a hostile acquirer. So it might be, you know, how this works is basically it would give more voting rights or more ownership rights or management rights, whatever, to kind of make the company less desirable to ward off any type of unwanted mergers. Now, greenmail, this is a takeover defense under which the target firm repurchases through private negotiations a large block of the stocks at a premium price from one or more stockholders to end the hostile takeover attempt by those shareholders. So in this particular way, they use money, and they'll pay extra money to those shareholders who are willing to sell that big block of stock to the acquiring company to prevent them from acquiring those shares, which would give them, the acquiring company, a high enough percentage of ownership to force the hostile takeover. So they call it greenmail because money's involved to sort of encourage these shareholders not to sell to the acquiring company in the hostile situation. Other takeover defenses include a leverage recapitalization, which is the target company will pay a large debt financed cash dividend, and this makes the company more highly financially leveraged and therefore less desirable. Golden parachutes, these are provided to in the employment contracts of key executives, giving them a sizable compensation if the firm's ever taken over. Now, the hostile takeover is less desirable if such generous amount of money is going to give it out to the management or executives of the company. So it could make a takeover unattractive, and you can see how management is all for that, and that's why the golden parachutes enacted in the time of a hostile takeover isn't as common as some of the other defenses. And there's also shark repellent, which are anti-takeover amendments to the corporate charter that constrains the firm's ability to transfer managerial control of the firm in the result of a merger. Okay, so a holding company is a common term, and it's a corporation that has the voting rights control of one or more other corporations. So the holding company is the one with the voting control, and the holding company may have in its portfolio a number of other companies. So they may, a holding company may need to own only a small percentage of the outstanding shares to have this voting control, as long as they have the majority. So the holding company that wants to obtain a voting control of a firm may use direct market purchases or tender offers to acquire the shares needed to get a majority. So the primary advantage of a holding companies is that leverage effect that permits the firm to control a large amount of assets in a relatively small amount of time. Disadvantages of a holding company include the increased risk resulting from the leverage effect, double taxation, and the high cost of administration. So if we look at the car company, a holding company, it currently holds voting control of two subsidiaries, Company X and Company Y. The car company, approximately 17%, which you take the $10 divided by 60 of Company X, and 20%, which you take the $14 over 70 of Company Y. These holdings are sufficient for voting control. So if you see in this simple example, we have the assets, the common stock holdings of Company X and Company Y gives us the total assets of the holding company. The holding company is nothing more than the two companies it's holding. So Company X has fixed assets of current assets of 30, fixed assets of 70 for a total of 100. Company Y has 120 and 140 for a total of 160. And if we look at the utilities, the liabilities, and stockholders' equity on the other side of the balance sheet, this is how how car company would use the two companies in its holding to become its own holding company. Now, the owners of car companies' $12 worth of equity have control over $200 worth of assets. So if we go back over here, and this $12 worth of equity here is controlling the total assets of Company X and Y, which together are 260. $100 for company X and 160 for 260. So thus the owner's equity represents only about 4.46% of the total controlled assets. So if an individual stockholder or even another holding company owns 3% of car stock, which is assumed to be sufficient for its control, then it would actually control the whole $260 million of assets. And the investment itself would cause, in this case, would represent only 1.15%. Let me just move this down a bit. And that would be 3.3 divided by 260 of the controlling assets. So these are just some of the, it gets a little sticky when you have these holding companies that are hanging on with a very low percentage of ownership. So why would someone do this? What are the advantages of having a holding company? Well, the primary advantage, of course, is leverage effect. You get, for a small amount of capital, you could leverage and permits the firm to control a large amount of assets with a very small amount of investment. The high leverage obtained through the holding company arrangement greatly magnifies the earnings and losses of the holding company. So hopefully the companies they're holding are profitable, which would really greatly magnify their return on equity. There is a risk protection. The failure of one of these companies does not result in the failure of the entire holding company. So if three are successful and one isn't successful, that net the company will still come out ahead. Lawsuits and legal actions against a subsidiary don't necessarily threaten the other remaining companies, and it's generally easier to gain control of a firm because stockholders or management approval is not generally necessary in the situation. Now, the disadvantages. A major disadvantage of a holding company is the increased risk resulting from the leverage effect. So more leverage equals more risk. There's double taxation. So before paying dividends, the subsidiary must first pay the federal and state taxes on its earnings and then give it to the holding company. And then the holding company must pay taxes. So holding companies are difficult to analyze because of their complexity, and there's a high cost of administration that results from maintaining each subsidiary company as a separate entity. So it also increases the costs. Now, there's no other area than the U.S. financial practice differ more fundamentally from the practices in other countries and then in the field of mergers and acquisitions. So a lot of things are similar in business across many different countries, but in mergers and acquisitions, the U.S. is particularly different. So outside the United States, hostile takeovers are virtually non-existent. So while the business environment is a little bit more free and capitalistic in the United States, other countries put a real hindrance on the ability to make a hostile takeover of another company. So the Economic Union in the EU, or more commonly known as, in their Economic and Monetary Union, EMU, integration involved the introduction of a single euro currency in 2002. The number, size, and importance of cross-border European mergers has continued to grow rapidly. So both European and Japan companies have been active acquisitions of U.S. companies as well. So in foreign countries have different laws about how you can the level of activities in mergers and acquisitions, specifically hostile takeovers. But what's interesting is that a lot of these countries across the world, in the free world and the capitalistic world, you are able to buy companies. A foreign company can buy a domestic company and vice versa. But there are some constraints. If you have, most notably, when China is trying to buy companies in the U.S., if they're defense-related companies, there are certain governmental procedures to be approved before those purchases can be completed. Or if there are companies that would transfer a huge amount of technological knowledge, those mergers may be also halted as well. Okay, so as far as international mergers, in 2005, an Australian-based media giant, News Corporation, launched a series of acquisitions in the U.S. So in 2007, News Corp had its sights on a new target, the Dow Jones. News Corp bid $5 billion for Dow Jones, but faced resistance from the members of the Bancroft family, which controls more than 50% of the voting power in the company. So the acquisition was completed in 2007, and the holders of each share of the Dow Jones stock was entitled and received So at the election, shareholders either 6% in cash or 2.8681 shares of Class B common stock in Ruby Newco, a wholly owned subsidiary of News Corp. So if you've been a shareholder of the Dow Jones, what trade-offs would you have considered when deciding whether or not to take the $60 per share or the shares in the Newco company? Well, I guess it's obvious you would want to see which would be the greater value to you as a shareholder. Okay, so let's talk about business failures and the fundamentals, types of business failure. So firms fail all the time, and it's quite common for a firm to have negative returns or have a loss. And a firm is consistently reported operating loss will probably experience decline in market value, most definitely. So the second type of failure is insolvency. This is when a firm is unable to pay its liabilities as they come due. They basically run out of money. So a bankruptcy occurs when the firm, the value of the firm's liabilities exceeds the fair market value of its assets. Then it is bankrupt. Now, continuing the major causes of bank failures, the primary cause of business failure, is mismanagement. So if the management expands too quickly, poor financial decisions, ineffective sales force, hiring ineffective people, high cost of production, all these can continue to combine to form a business loss. Economic activity can also contribute to a loss of firm. If the economy goes to a recession and your company is particularly recession sensitive, that could leave the company vulnerable to insufficient revenues to cover their costs. So rapid rises in interest rates in certain industries prior to a recession can contribute to cash flow problems, make it more difficult for them to obtain financing. And the final cause of business failure is just corporate maturity. The corporation just is not competitive anymore. So let's talk about too big to fail. So what if a company is so big and so involved in the economy that having it fail is not a question? So if you look at General Motors, it's ranked as one of the largest corporations in the world. If you look at sales and market capitalization, but by the end of the first decade of the new millennium, GM's fortunes have changed. So on June 1st, 2009, GM filed for bankruptcy protection. Aware of the company's importance to the economy of the U.S. and Canadian governments, provided financial support to receive ownership stakes of 60% and 12.5% in the company. So who benefited and who loses from a firm becoming too big to fail? So do financial managers have incentives to make their firms too big to fail? What are some of the actions they might take to increase their firm's importance? So this is just basically recognizing some companies have so many employees or so integrated into an economy that failing would be too much of an economic blow to the economy to allow the business to fail. While others feel that if a company is not making it, if it's not doing well, it should be allowed to fail so that other companies could have, who are better and better use of economic capital, could come up and develop and be more successful. So it's really split among a lot of people if we should let companies fail and not support them in their time of need, and allow other companies to rise up and be developed, or maybe it's a national interest that you don't want your only airplane manufacturer or one of your big auto manufacturers to go out of business and have foreign competition step in and fill the void. So I mean, definitely who wins are going to be the employees and the management. Who loses may be taxpayers if the money isn't wisely invested. But in the case of GM, the money was paid back early even. Some of the management lost some ability to make decisions and control the company as the governments became a larger stakeholder. So it's a pretty complex thing to look at. And also other companies that are too big to fail were certain very large banks that were looked at as too big to fail and were lent huge amounts of money to keep in business, fearing for the credit crunch that could happen to the economy if the bank was allowed to fail. Okay, let's discuss a voluntary settlement. So this is an arrangement between an insolvent or bankrupt company and its creditors, enabling it to bypass many of the costs involved in legal bankruptcy proceedings. So an extension is an arrangement. It's just like what it sounds like. It's an arrangement where the firm's creditors receive full payment in full, although not immediately. The terms are extended. Composition is a pro rata cash settlement of creditor claims by the debtor firm. A uniform percentage of each dollar owed is paid. So this, let's say, we owe you X amount of money. Will you agree to take 40 cents on the dollar? And that way they can kind of come to an agreement, and they can emerge from bankruptcy more quickly. Creditor controlled is an arrangement in which the creditors committee replaces the firm's operating management and operates the firm until the claims have been settled. So these are three ways to make a voluntary arrangement between the company and the creditors to bypass the bankruptcy proceedings and sort of come to an arrangement before a full bankruptcy is declared. Now, liquidation can be carried out in two ways: privately or through a legal procedure provided by bankruptcy law. So liquidation is basically the company just closing down and selling all the assets. And the objective of voluntary liquidation process is to recover as much per dollar owed as possible. And the assignment is the voluntary liquidation procedure by which a firm's creditors pass the power to liquidate the firm's assets to an adjacent bureau, a trade association or a third party, which designates as the assignee. So that way they can be more confident in the fairness of the liquidation of the assets to pay back the creditors. So this is generally when companies there's nothing of value to run the company anymore, so you might as well try and get whatever you can from the assets. All right. Here's some of the largest bankruptcies in history. Lehman Brothers was the largest bankruptcy in 2008. And you see a lot of these are 2008, 2009 during the Great Recession. Washington Mutual, WorldCom, General Motors, CIT Group, Enron. You see that only a handful of these companies still exist. Some of them, like Chrysler and GM, were helped out by the government. Some of them were acquired, such as Washington Mutual, I believe. When they went bankrupt, they were eventually liquidated and the assets sold to Chase. So sometimes bankruptcies work out and companies emerge from them and become successful again, and sometimes the companies disappear. So this leads us to our next segment: reorganization and liquidation in bankruptcy. Bankruptcy legislation. So bankruptcy is a legal set of laws. Now, since the firm can't pay its bills, or when the liabilities exceed the fair market of the assets, bankruptcy protection may make sense for a company. So the Bankruptcy Reform Act of 1978 is the governing bankruptcy legislation in the United States today. So Chapter 7 is, and this is just for corporate, this is not personal. So Chapter 7, the portion of the Bankruptcy Reform Act in 1978 that detail the procedures to be followed when liquidating a failed firm. So Chapter 7 is when the firm fails. Chapter 11, which is more common, is the portion of Bankruptcy Reform Act of 78 that outlines procedures for reorganizing a failed or failing firm, whether its petition is filed voluntarily or involuntarily. So Chapter 7 and Chapter 11 are two different forms of bankruptcy, and each of them have their own different subset of rules and regulations about how to proceed and the protection, most importantly, the protection companies get from creditors when they file a bankruptcy to give them a chance, in some cases in Chapter 11, to restructure and reorganize. Okay, so there are two basic types of reorganization petitions. One is a voluntary, and of course the other is an involuntary. In a voluntary reorganization, the petition is filed by a failed firm on its own behalf for reorganizing its structure and paying its creditors. An involuntary reorganization is petition initiated outside the company, usually by creditors, for the reorganization and payment of the creditors of the failed firm. So sometimes companies will be forced to reorganize. An involuntary petition against a firm can be filed if one of three conditions are met. Number one, the firm has past due debts of $5,000 or more. Two, three or more of the creditors can prove that they have aggregate unpaid claims of $5,000 against the firm. If the firm has fewer than 12 creditors, any creditor that is owed more than $5,000 can file a petition. And three, the firm is insolvent, which means that it is not paying its debts as they come due within the proceedings of 120 days. Custodian third party was appointed to take possession of the debtor's property and or C, the fair market value of the firm's assets is less than the stated value of its liabilities. Okay. Now, continuing with Chapter 11, a reorganization petition under Chapter 11 must be filed in the federal bankruptcy court. So, the debtor in possession, or DIP, is a term used for a firm that files a reorganization petition under Chapter 11 and then develops a feasible, if feasible, a plan for reorganization. So, a hearing is held to determine whether the plan is fair, equitable, and feasible, and whether the disclosure statement contains adequate information. The court approves or disapproves is based on the evaluation plan in light of the standards. Once approved, the plan and disclosure statements are given to the firm's creditors and shareholders for their acceptance. Now, you may have known somebody or talked to somebody who has gone bankrupt. So individuals like corporations sometimes fail financially, and their bankruptcy law is specifically for individuals. So individuals in dire financial situations have two legal options, a wage earner plan or a straight bankruptcy. So a wage earner plan, defined under Chapter 13 of the U.S. Bankruptcy Code, is a workout procedure that involves some type of debt restructuring, typically establishing a debt payment schedule that's workable in light of the individual's personal income. So it would give you some protection from creditors and try to establish a repayment plan that would be fair to you based on what you make. Now, a straight bankruptcy is allowed under Chapter 7 of the Bankruptcy Code. This illegal procedure is similar to liquidation of a corporate bankruptcy. It effectively allows a debtor to wipe the clean slate and start anew. So if you were somebody who had a lot of personal debt, credit card debt, bank loans, you could take this bankruptcy under Chapter 7 and clear yourself of those debts and start over. However, one area to I feel I should highlight here is that student loans are not do not participate in bankruptcy. So if you have student loans, you can file all the bankruptcies you want. They will not disappear based on Chapter 11. You will always owe those student loans, and you cannot use bankruptcy to escape from them or to diminish them in any way, which is why taking on student loan debt is additionally risky, because you really cannot escape from that debt if you have financial circumstances that you're incapable to pay them back. Okay, so because reorganization activities are largely in the hands of the debtor in possession, the DIP, it's useful to understand the DIP's responsibilities. So if you're a DIP, debtor in possession of a company, the first responsibility is the valuation of the firm to determine whether reorganization is possible and profitable and appropriate. So recapitalization is a reorganization procedure under which the failed firm debts are generally exchanged for equity, or the maturities of existing debts are extended. So some sort of reworking of the debt. And once the revised capital structure has been determined, the DIP must establish a plan for exchanging outstanding obligations for new securities. And once the debtor is in possession, has determined the new capital structure and the distribution of capital, it will submit a reorganization plan and disclosure statement to the court as described. And the court will deem whether or not that's fair, and they should proceed and move forward. So the liquidation of a bankrupt firm usually occurs once the bankruptcy court has determined that reorganization is not feasible. It's just not going to work. So when a firm is judged bankrupt, the judge may appoint a trustee to perform the many routine duties required in the administration of the bankruptcy. The trustee is given the responsibility to liquidate the firm, keep records, examine creditors' claims, and distribute money, furnish information as required, and make final reports on the liquidation. It is the trustee's responsibility to liquidate all the firm's assets and distribute the proceeds to the holders of provable claims in the order of seniority to least senior claims. After the trustee has liquidated all the bankrupt firm's assets and distributed the proceeds to satisfy the provable claims in the appropriate order of priority, which I was mentioning before. Senior bonds get paid first, and then debentures, and so forth, and finally shareholders. after all the creditors have been paid first, he or she makes the final accounting to the bankruptcy courts and its creditors. So you have secured creditors. These creditors have specific assets pledged as collateral, like a house or land, in liquidation of the failed firm and receive proceeds from the sale of those specific assets. Unsecured or general creditors are creditors who have a general claim against the firm's assets, but not specifically pledged to any particular collateral. So they'll get their money will be paid out of a pool, either partial coverage or total payment repaid back depending on how much money is generated on the liquidation. So we've talked priority of claims in liquidation of a failed firm. Number one, the expenses of administering the bankruptcy proceedings get paid first. Of course, the courts get their money first. Two, any unpaid interim expenses incurred in the ordinary course of business between filing the bankruptcy petition and formal action by the court in the involuntary proceedings will get paid second. Third, wages not more than $4,650 per workers that have been earned by the workers in the 90-day period immediately preceding the commencement of the bankruptcy proceedings. Fourth, unpaid employee benefits contributions that were paid in the 180-day period preceding the filing of bankruptcy or the termination of business, whichever occurs first. For any employee, the sum of the claim plus eligible unpaid wages in item 3 cannot exceed $4,650. 5. Claims of farmers or fishermen in the grain storage or fish storage facilities not to exceed $4,650 per producer. 6. Unsecured customer deposits not to exceed $2,100 resulting from the purchase or lease of goods or services in the failed firm. 7. Taxes legally due and owed by the bankruptcy firm to federal government, state governments, and other government subdivisions. 8. Claims of secured creditors, so those who receive proceeds from secured collateral. 9. Claims of the unsecured creditors. 10. Preferred stockholders, the amount up to par are stated, the value of the preferred stock. And then 11. Common stockholders who would receive any remaining funds distributed after everybody else is paid back. So generally, common stockholders don't get much at all, if any, since they're at the bottom of the list. Okay, that concludes Chapter 18, and in this chapter we talked about understanding the fundamentals of mergers. We talked about the basic terminology, motivations for mergers, and types of mergers. We looked at and described the objectives and procedures used in leverage buyouts and divestitures. We demonstrated those procedures used to value the target company and discussed the effects of stock swap transactions on earnings per share. We discussed the merger negotiation process, holding companies, and international mergers. And we talked about the types and major causes of business failure and the use of voluntary settlements to sustain or liquidate the failed firm. And finally, we explained bankruptcy legislation and the procedures involved in reorganizing or liquidating a bankrupt firm. Thank you so much for your time, and I hope you enjoyed this presentation.